Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Hey, good morning. Welcome to the second best day of the week here for The Real Investment Show. I'm your host, Lance Roberts, of course, as we get ready to kick off this Thursday. And it's kind of alert day, as we've been talking about here lately. Yesterday, markets sold off and are now sitting right on that 200-day moving average. And the important thing about this is that, as we discussed yesterday, there is a tremendous amount of program trading that runs in the markets these days. We have so many computers and algorithms and everything else that are driving stock trading from one side of the ledger to the other, that these technical levels are now becoming much more critical than they were ever in the past, because this is where all these programs, because everybody kind of uses the same technical analysis in one way or the other, all these automated sell programs are kind of lined up at these same levels. So we're now at that kind of very critical level, which is that 200-day moving average. It's also where the uptrend line from really those October lows also intersect. So there's a tremendous amount of support right here where the market is today. Now, Dow's up a little bit this morning, about 90 points. The S&P's down about 10 right now. Nasdaq's down about 75. Now, those levels have recovered markedly from overnight. They were down a lot more last night. They've been recovering a bit this morning. We'll see what they look like as we get closer to the open. But it's very important that markets kind of find some support here and get a little bit of a rally. Now, I want to talk about one thing here importantly. And we touched on this in today's daily market commentary as well. So if you go to the website, realinvestmentadvice.com, you'll find our daily market commentary. I've already posted it this morning, so it's there. You can also subscribe to have it sent to you every morning at 7:30. But we always post a trading update of some sort in that piece. And the one thing we talked about today was, you know, you've got to be careful when you get these breaks of support. Now, it is possible that we will break the 200-day moving average today. There's been a good bit of selling pressure over the last 2 weeks. Markets are oversold on a short-term basis, and there's been a real steady push of selling for the last couple of weeks. So again, if we break this 200-day moving average today, right below that is the 100-day moving average sitting just below the 200 days. So there's another level of support just immediately below that. So if we do break that, you may see some accelerated selling here very short term, like for the day. And you might see a fairly sharp push lower if we break that level. And that's going to be that program trading kicking in. But you've now got this support sitting right below that. Now, what's important is and there's a reason why a lot of traders historically or investors, they go, oh, technical analysis doesn't work. You know, I had a stop loss, I got stopped out, and then the stock went immediately back up. And that's because everybody is setting on these same levels. So there's also program buyers sitting out there at these levels as well saying, well, if it breaks below this level, I'm going to start buying because that'll be a good opportunity. So it depends on where that program trading is set up. But what happens historically is we'll get these breaks of a moving average. Now, here's how to tell when to actually act on that break of the sell. Don't do it immediately. If we break below the 200-day moving average today, it's okay. Sit on it till tomorrow. We really need to see where the week ends overall. So again, if the market breaks below the 200-day moving average today, don't do anything today. Wait till tomorrow, because a lot of times you'll start to see some buying that comes into the market immediately around these support levels. You may go a little bit below that for a day or two, and then the market rallies up. So give the market a day or two to try to work through the break of any support that you get before you start taking action. So again, this is why when we talked about getting the sell signal 2 weeks ago, we took action back there to actually raise some cash in portfolios and to reduce some equity risk. And we've kind of been doing a little bit of selling all along the way, just trimming around here and there, just to raise a little bit more cash and reduce risk. So if we do get a break tomorrow, we don't have to do a lot of work because we've already done some of that work. But again, if we do get a confirmed break of that moving averages and those supports, then we can obviously take more risk off the portfolio. But be careful though, knee-jerking the sell-off if that happens. Don't immediately just, oh, it broke 200-day moving average, I'm gonna go sell right now. that typically, historically, many times does not work out well. You'll get that initial break and then the market will rally right back. So again, look for that break, but then look for a reflexive rally to sell into, because if we do break that, we're likely to get a bounce for a day, maybe two, and then the market's going to get some more selling pressure as traders that are kind of trapped into the markets look for an exit opportunity on the upside. So again, there's a little bit of a psychological game that goes on with the market. So, when you're looking at, at these technical levels, understand that there's a lot of program trading sitting there. You're going to have some of these kind of knee-jerk reactions, but then there's going to be buying that will come in as well. And particularly when you have so many days in a row where you've just had this kind of a grind lower, it's what we call a selling stampede. Now, we have buying stampedes and we have selling stampedes. Now, earlier this year, from really January through early February, we had a buying stampede. Every day was almost an update. And when even if you had a down day early, it rallied back at the end of the day as buyers are coming in. So we had this kind of stampede of buyers. Those buying stampedes typically last between 13 and 15 trading days on average. Now, they can go longer. Obviously, in January, that was a very long buying stampede that occurred, and a lot of that has to do with momentum. Well, now we're down into about 10 to 11 days of a selling stampede so far, so we're starting to get fairly long in that selling process of the markets. So again, we're kind of starting to work through sellers, at least temporarily. So again, a bit of a bounce in the market would not be surprising. Use that bounce to sell into. Right now, if you could get a bounce up towards that 20-day moving average, that would be a really good opportunity to lift some exposure out at better prices. So again, just the whole point about where we are right now, and we're going to get into a lot more of this conversation this morning, is the market is now trying to figure out what the Fed is going to do next. And that's going to be the real question, because Nomura Securities out this morning, they're one of the first banks to come out and say the Fed's going to hike 50 basis points at the next meeting in March, which is coming up very shortly. So that's now the first call for a 50 basis point hike. The Fed terminal rate, as we'll talk about with Michael Leibowitz this morning, is now up to 5.5%. So this whole idea of the Fed pivot or the Fed pause that was driving this market narrative really since October of last year is now starting to meet with the reality, which is that inflation is not slowing as fast as the markets were predicting. And there's really no sign right now that the Fed is going to really pause on rate hikes because of the strength of the economic data, which may be a real problem, because something we'll talk about this morning as well is those job numbers, which there's a big lag to those job numbers and the way that that's reported. And that could really turn out to be a surprise later this year, as the employment data is actually a lot weaker than what headline numbers currently suggest. So again, we've got a lot of stuff to get into this morning about the market, so stick around. Michael Leibowitz is going to join me. Get by the website, realinvestmentadvice.com. Get our latest newsletter, which will be out this weekend. So make sure you're subscribed. Going through valuations and earnings reversions this weekend, and why that's important to your money and how we're trading that. That'll be in this weekend's newsletter. So make sure you're subscribed at the website, realinvestmentadvice.com. Daily market commentary, and of course our Before the Bell channel. That's our new YouTube channel for our 3 minutes on markets and money we do every morning. So again, all there at the website, tons of stuff, all free, of course, to help you manage your money better. We'll be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately, for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Good morning and welcome to the Real Investment Show. I'm your host, Lance Roberts. So, we talked the other day about women having advanced degrees. You know that women make the best archaeologists? Yeah, they're great at digging up the past. So this morning I'm cranky because I've had no coffee this morning. My wife apparently has a mental disorder. I'm not sure exactly what it is yet or what the classification for it is, but about once a month, she doesn't get the coffee pot actually fully into the coffee maker. And so you wake up with a kitchen full of, and since I get up first, right, I walk into the kitchen and there's 12 cups of coffee all over the floor. So coffee grounds. It's a great way to start the morning, let me tell you.
There's only one thing worse than that, and that's when you go to do your Keurig, which we have one here at the office.
Right. Yeah.
And it's dark in the kitchen, and I put the mug in upside down.
Okay, Brent, I want to help you with this problem. There's this thing that's on the wall.
Yeah.
It's called a light switch.
It doesn't work that early in the morning. The lights don't come on around here in the office till like 6. So I'm in there doing coffee in the dark.
All right, flashlight on your phone is an option.
I guess.
Anyway, good morning. I'm also I'm thinking about launching a new YouTube channel. It can only be a YouTube
Another
channel.
one?
Yeah.
Yeah.
And I was thinking about this last night.
Okay.
So, and this could only be a YouTube channel. It cannot be live radio because of FCC regulations. But I get these emails from people asking me and look, they're honest questions. But my father always said growing up, he's like, no question is stupid if you don't know the answer.
Right. Yeah.
But then there's some questions that people ask that you should just know better, right? So
just keep to yourself.
And just don't ask that question. But the point is that there's a lot of financial literacy in the world. We don't teach people the use of money and how to build wealth. And again, what you see on TikTok with everybody going, "Hey, you want to make $10,000 a month? Be an affiliate," right? That just slow down.
It's financial caca.
So I'm thinking about launching a new YouTube channel.
Okay.
And we're gonna go get people with when these people email me these financial questions, we're gonna bring them into the studio, right? And I'm gonna have like Gordon Ramsay show up and do Gordon Ramsay on financial illiteracy.
That's good.
Yeah.
Yeah.
I think it will be.
That'll go.
Yeah. But the profanity will be.
We may have to put plastic down on the carpet in here.
Could be. But obviously, you get a good Gordon Ramsay type person to do this. I think that could track. I think
it probably would.
I think that would get a lot of views.
It's like that guy that visits college campuses and asks, simple questions.
Oh no, I'm just talking about some guy yelling at people.
Yeah.
Like kind of like Hell's Kitchen meets financial literacy.
Who is that guy that drill sergeant Army? Remember him?
Yeah.
We need to get somebody like that.
There you go. Exactly. Full Metal Jacket.
Yes.
Yes. Exactly. All right. A couple of things this morning. So markets are down a little bit. They were down a lot more last night. When I actually woke up at like 3 o'clock this morning and looked at futures, the NASDAQ was down over 1%. And futures have recovered here over the last little bit. So we'll see how we do kind of going into the market open this morning. As I was saying, we're sitting right on that critical support of the 200-day moving average as of yesterday's close. So, what the markets are trying to figure out is really what's going to happen next. And interest rates in the 10-year have now broached 4% again. We're taking a look at the 2-year Treasury rate, which it's pushing 5% now. And this all kind of relays back. It goes what the bond market is suggesting. And again, if you take a look at Fed funds futures, they are now suggesting that the Fed's terminal rate is now going to be 5.5%. Now, just remember, back at the beginning of December and really kind of going back to October, when this rally started, the general view by the markets and by most investors was, the Fed's getting ready to stop hiking rates. They're gonna pivot on their policy. And the expectation was about 5% on Fed funds being the terminal rate. We're now up to 5.5%. There's now a 40% chance, which in January it was 0. There's now a 40% chance the Fed goes 50 basis points at this next meeting because of the strength of this economic data that we've had come in lately. So again, there's been a very significant narrative change to the markets, and the markets surprisingly are holding up very well here despite this narrative change. But that has certainly been coming into the pressure of the markets. And importantly, there's a big divergence between real yields and valuations. And one of those have to give. At some point, valuations are going to catch up with real yields, or real yields are going to reverse and catch up with valuations. I suspect it'll be valuations ultimately catches up with real yields, because that has everything to do with economic growth. But here, let's talk a little bit about the Fed meeting, which is coming up very shortly. I believe it's week after next, Mike, if I'm not mistaken.
March 22nd. So I think it's 3 weeks?
3 weeks. Okay, so 3 weeks. But again, Mike, this is kind of the big thing here. I find, there's a rising probability by the markets the Fed goes 50 basis points, but the Fed's been pretty clear that they want to wait for this lag effect. Do you think they go just 25 basis points, but with an expectation they might hike for 2 more meetings, maybe?
Yeah, I think the Fed's starting to run into a little bit of a problem. They're running out of airstrip. They know they can't bring Fed funds up to 6.5 or 7. It's just too much. So, but they're not going to say that out loud. They're gonna continue with their very hawkish tone, but they have to leave themselves some more room to hike. So to me, it makes sense to just keep doing 25s. That way they can go for at least 3 more meetings, which there's 6 weeks, but 6 weeks, I think, between each meeting. That buys them a lot of time to talk hawkishly, to act hawkishly, but not, 18 weeks, 3 meetings, you can bring Fed funds up 75 basis points to 5.5.
Okay.
And they're still sticking to their word. They can talk a mean game. Maybe they can increase QT a little bit. Maybe they can do QT slightly different so it has a bigger effect. But I just think that doing 50 is a mistake, A, because they start running out of room if they need to keep doing more, and B, because it is, the lag effects are so important here, and they're not giving time for the lag effects to take effect. The first rate hike still isn't even a year old.
Yeah.
So that was 25 basis points going from 0 to 25. We're in the upper 4s talking about 5s now.
Yeah. And Mike, real quick, just to put this in perspective for everybody. We talk about the lag effect. We talked about this before. Generally, it's 9 to 12 months. So that first rate hike at 25 basis points, if you assume 12 months, hasn't even showed up. It's showing up in the economy this month. But importantly, and what Mike's talking about, there's 475 basis points of rate hikes. This is since March of last year. So in a 1-year period, March of last year to March of this year, which we just started, this is the most number of rate hikes by the Federal Reserve ever, going back to like 1950s, right? If you go back and look at their historical record. So this has been the most aggressive series of rate hikes. Now, they've hiked rates more in the past, but if you go back to the late 70s, they continued hiking rates, but it took more than a year. So, this has been a very aggressive rate hiking campaign. And when you start thinking about, to Mike's point, there's a lag effect on the economy. We're starting to see housing slowing down. But, the problem for the Fed, and one argument for the Fed hiking 50 basis points is this, is that if you look at the employment data, retail sales data, these type of things, the economy is still going very strong. And one of the arguments for hiking 50 basis points is to try to slap the consumer upside the head and say, stop spending money because I need you to slow down so that we can get inflation down. And so one of the arguments has been they need to hike 50 basis points to try to put a bigger brake on this stronger economic data. But Mike, I have to believe that the Federal Reserve is smart enough to know that A, this economic data has a huge lag effect, and B, there's potentially problems with the data because of what we did to the economy in 2020, and by shutting the economy down, laying all these people off, then turn around and hiring them back. There's a potential problem with that data that it may take several years to kind of work out that kink. So to your point, I think the Fed's going to be more pragmatic and say, hey, let's do this at 25 basis points, but just give but then talk very tough about continuing to hike rates further into the future.
Yeah, I think that's right. They understand the lag effects. They talk about it. They talk about their flaws in their data. Jerome Powell talks to a lot of business leaders and industry leaders, and he knows what's going on, and he knows that the on the ground it's not as rosy as some of these economic data points are telling us. So he's got to act with caution at this point, or he's going to break something. The question is just how big is the break?
Right, and again, this is the big question. There's some very interesting commentary out this morning, talking about the senior loan officers lending survey, right? And this is really about the tightness of lending conditions. So if you want to go to the bank and borrow money, just how hard is it to borrow money? This has a big impact on the economy, obviously, because credit's the lifeblood of the economy. We'll talk about this when we come back from the break and one of the messages that's sending, because if something is going to break, to Mike's point, it's going to be in the credit markets first. That's the thing that rolls over into the financial markets. We'll talk about that when we come back from the break. Don't go away.
Step into the confusion. Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the economy right now, 10.8 million men have advanced degrees. Pretty good. 11.9 million women have advanced degrees. Grad school is a great place to meet the ladies. It's the new nightclub.
Hey, baby, what's your major?
The Real Investment Show podcast. Same show, your schedule.
My wife actually has advanced degrees. She's very smart. She has advanced degrees in both the memory of everything I ever did wrong and always being right.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, welcome back to the show this morning. So one of the big questions is, and this has been kind of the interesting debate as of late. Michael actually wrote an article on, what day was that? Wednesday. Forget what day of the week this is. Mike wrote an article yesterday talking about the no landing scenario and its equivalency to UFO sightings. But, this has been one of the big debates is, well, the Fed's hiking rates, you have an inverted yield curve, but there's no recession, so maybe this time is different. We're not going to have a recession. Well, again, just as with Fed rate hikes, it takes time for a recession to occur as the economy slows down. So, again, if you think about something very simplistic, like throwing a ball into the air. So if I throw a ball in the air, there is a point at its apex that it is literally hovering for a very brief second. It had the momentum has declined and the ball comes to a complete stop midair before it begins to drop back to earth. Now, if the recession is technically when the ball hits the ground, it takes some time for the ball to fall from its apex back to the zero line or the ground. And that's the same thing with economic data. Just because we haven't had a recession yet doesn't mean the economy isn't slowing down. We had such a big surge in economic growth because of $5 trillion worth of liquidity that as that liquidity leaves the system, it's going to take time for that momentum of economic growth to slow down enough to put the economy back into a recession. Okay, now, having said that, there's some indicators. Now, this goes back to what Mike was saying just a second ago before the break, talking about this lag effect and the Fed's tightening policy, and actually goes to the heart of his article yesterday as well, is that we're starting to see the evidence of those things in the economy that have a good leading indication of a recession. So yield curves, we've talked about those. And it's not when the yield curves invert, that's the warning sign. It's when they uninvert that is your indication of recession. And it's those uninversion yield curves. Another one is the senior lending officer survey that comes out, and that talks about that, bank loans in particular are lenders wanting to loan money out, and that has become very tight as of late. And if you take a look at history, where we are with the senior lending loan officer survey right now, we're somewhere between 2007 and early 2008. So again, it's kind of this leading indicator. Now, you'll remember back in 2007, the economy was slowing down, but everything was okay. And in 2008, Ben Bernanke was still saying it's a soft landing economy, it's a Goldilocks scenario, subprime is contained. And it wasn't until December of 2008 that the National Bureau of Economic Research came out and said, oh, yeah, the recession started last year, right? Everybody knew we were in a recession by the time Lehman came around. But up to that point, everything was fine, right? We were having a little bit of a decline in the markets. Bear Stearns failed, but they got bailed out and the markets went right back up. There was no concern, right? Very similar to today. So again, we're talking about these lag effects. And Mike, to your article yesterday, this idea of this no landing scenario is really kind of interesting because people that have lived through these periods, but now look, if you've never been through it, if you weren't investing in the markets back in 2007, 2008, and there's a lot of people that weren't, you don't really, it's easy to fall into these narratives about no landing scenarios and soft landings. But, having been through this before, Mike, we've seen these indicators before warn about, worst possible outcomes, and people just were in denial of it until after the fact.
Right. After I wrote the article, after I published it Wednesday, the better title should have been "No Landing, No Way." The more, as I wrote it and dug into it and produced charts and went through data, it almost seems impossible. Now, I'm not going to say it's impossible after everything we've been through for the last 3 years, because there is a lot of stimulus in the system that's just unaccountable for. It's from a couple of years ago, and it's still out there, and it's real. And it's counteracting some of these headwinds. And we'd be dumb not to see that. So there are some positives to the economy still from all that stimulus. But there's a lag effect on that too, and that lag effect basically means the stimulus is slowly leaking from the system. How much is left, how much is leaking, it's really hard to tell. And some of it is psychological. It's consumer sentiment, and people want to buy cars, they want to travel, they want to do stuff, they want to reward themselves. They just got raises, so they feel empowered to spend more, to go out to dinner more. And we're seeing that in the data. But here, and Lance, when you said this is like 2007, 2008, there may not be a subprime crisis this time, but the bigger problem is there's a lot more debt in the system than there was in 2007, 8. And not a lot of debt. When I say there's more debt, it's not just the amount of debt, the notional value of debt, it's debt as a percentage of GDP. GDP is essentially our income. It's our ability to pay for the debt. So the debt to GDP ratio for corporations, for the U.S. government, and to a much lesser degree for individuals is much higher than it was in 2007, 2008. So I think, and we're at a point, the economy has been trending lower for 30 years. And I write about this in the article. That's a function of more debt, which initially boosts economic growth, but then becomes a tax on economic growth if it's not used productively. So you look at productivity, which is the productivity growth rate is still growing. We're still more productive today than yesterday, but that rate of growth is slowing, and the demographics are starting to turn against us, but they are still behind us. So they help a little bit. But the amount of help we get from productivity and demographics is less and less. And because of that, the true economic, the natural economic growth rate now is estimated to be between 1.5% and 2%. And even the Fed's long-term forecast calls for 1.8% growth. So you have a 1.8% growth economy with 5% plus interest rates, and that's not going to go well. The interest rates over where the natural growth rate is just way too high for an economy that is over leveraged and very dependent on debt. The problem is the debt doesn't just all come due at once. The problem is we don't just all go buy cars the same day. I may not need a car for 6 months, so it doesn't matter to me what car loans have done. But when I go into that showroom and I realize I can't afford that $50,000 car because the loan is 7%, and I either have to settle for a used car or a lesser model, that starts slowly affecting the economy. But there's only, I don't know the numbers, but just say a few percent of the people every month that need to or want to go buy a car. So there's just a small percentage of the population, but it's increasing every day, every month that is being affected by interest rates. Same thing in the housing market. You would think the housing market would be crushed with mortgages at 7%, and buyers have stopped buying, but sellers aren't selling. There are very few homes on the market. The supply of homes today is still, of existing homes, not new homes, is still about 3 months of supply. That's the lowest it's been outside of the last couple, if you go back before the pandemic, that's the lowest it's been for at least 5 years before the pandemic. So buyers aren't buying, sellers aren't selling, so it really doesn't affect house prices if no one's doing anything. It's just at a standstill.
Right, and that's the interesting thing about higher mortgage rates, right? Is that there are houses that are coming for sale, right? And that's we're getting into that kind of selling season right now. People want to sell their house to move or whatever. But if I'm a homeowner, this is the big conundrum about mortgage rates. So when mortgage rates are 3 or 3.5 or 4%. Then if I'm looking to sell my house, I go, okay, I can sell my house, take that cash, roll it into a new house, get a 3% mortgage and 3.5% mortgage, whatever it is, and I can make that move. If I'm a buyer, I'm going, okay, great, I'll buy a house and my mortgage is 3.5. When mortgage rates go to 7, people are going, I can't afford to buy a house because now the mortgage is too much. And as a seller, I'm going, great, I can sell my house, but I don't want a 7% mortgage, so I'm not going to sell my house, right? And so it's I'm just going to sit where I am. I'm fine until maybe when rates come down, I'll sell my house. But it's an interesting conundrum. It's a standoff between buyers and sellers. It's all driven by high rates.
Well, think about this. Let's just say you have $1 million house with just a little bit of equity in it, and you say, I want to sell and I want to downsize. So you put, you want to sell $1 million house, and then you're saying, okay, well, what can I afford? Well, to have the same mortgage payment, the answer may be $650,000, $700,000. Mm-hmm. So, you're going to sell $1 million house, a bigger house, buy a $600,000, $700,000 house, and in theory, you're doing that to lower your mortgage, and you don't need all that space, but it's the same mortgage payment. So I think a lot of sellers are like, well, I might as well just stay where I'm at. Yeah. There's no reason to move.
Yeah, and it's a little bit of bad math. I mean, basically, if I'm selling $1 million house to buy a $600,000 house, go ahead and have a higher mortgage payment. You can always refinance later. If you wait too long, the price of your $1 million home is going to become $900,000. So you may be selling at the worst possible time. But it's an interesting conundrum. There's definitely the standoff in the home markets because of high mortgage rates. But that's also in the rest of the market as well. High interest rates impact the consumer. That's what slows economic growth. That's what the Fed wants to lower inflation. We'll be right back after the break. Wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So one of the things that the Fed has been discussing lately with their policy meetings has been the strong U.S. employment growth. And I thought this was interesting because John Hilsenrath. So quick backstory on John Hilsenrath. He works for the Wall Street Journal, and he was the former Fed whisperer before he was very unceremoniously dumped for the younger and more controllable Nick Timros, who has now taken his spot. But he wrote a very interesting article called, it's on the Wall Street Journal today, it's called Long, Robust U.S. Labor Market Show Signs of Cooling. And this has been one of the big discussions Mike and I have had recently as well, and is that when you take a look at these employment numbers, there's a lot of seasonal adjustments to them, and the numbers just don't really seem to jive with kind of what we see going on real time elsewhere in the markets, right? So if you take a look at some of the real time economic data and you look at the employment data, it just doesn't really kind of line up. And this was kind of the point that John Hilsenrath touches on in this article for the Wall Street Journal. Let me read you a quote, and then we'll talk about this a little bit, Mike. Figures from ZipRecruiter, Inc. and Recruit Holdings Company, two large online recruiting companies, show the number of job postings on their sites declined more late last year than the Labor Department report on job openings for that period indicated. The company's report available jobs fell further this year, potentially foretelling to a decrease in openings in coming Labor Department reports and a slowdown in hiring this year. This is something Mike and I have talked about previously. And when it comes to employment data, we have a lot of real-time economic data. Unemployment, ADP, paychecks, these kind of payroll companies. These are the companies that if you want to hire somebody and these are the largest payroll companies out there, you tell them, hey, I just hired Mike Leibowitz to come work for me. Here's his salary. He's full-time or he's part-time or he's 1099. They have all that data. But yet the Labor Department still uses a telephone survey, calls 60,000 homes, for the quarter and says, hey, are you working or not? And they adjust those numbers and they do a lot of mathematical things and make the 60,000 person phone survey apply to 330 million people across the country. So rather than using real-time, on-the-ground data, we're still doing this other stuff. And that's why there's this discrepancy potentially. And of course, with a lot of adjustments about the birth-death adjustment, then it's kind of a wild guess at, how many businesses were created or failed. Those numbers are wildly inaccurate, but it all has an impact on these employment data. Same thing with job openings. Mike and I have talked about the number of job openings that when you see layoffs that are going on with companies, even though a lot of them have been tech related, if they're laying off people, there have to be less job openings, yet we keep seeing these job openings numbers, ratchet up. And so now what we're getting, and this is what John Hilsenrath talks about, is that the data from the real-time sources are becoming markedly different than what the government sources are reporting. And that will potentially lead to a bigger adjustment to the data. And this is what we've talked about before, is that be careful with this data, because the economic data published by the government is subject to very large revisions, particularly when you go into a recession. You get this backdating, and again, we don't care about, the markets don't care about this. The media will give you those, the employment this month was 100,000 people, and we revised the last 3 months by 4 million people. Nobody will know that, right? But you'll see this slowdown in the data, but the adjustments to the data, and this is why the National Bureau of Economic Research is always late in dating a recession, because they have to wait for these revisions, and then they come back and say, oh yeah, the recession started 9 months ago. Well, it doesn't do you much good as an investor. That's why we need to pay attention to what this data is telling us real time and apply that to what our outlooks are. Mike, your thoughts on this?
Yeah, the job openings is probably one of the easiest to explain why it's so high. If you owned a restaurant 10, 15 years ago, casual restaurants, so you're hiring not a lot of professional waiters, but a lot of 18 to 20 somethings, you're always losing staff. They're always quitting. They're not showing up. You have to fire them. So 15 years ago, you would have a job opening sign on the front, and maybe you'd spend some money and post it in the local newspaper. But that was expensive to post an ad in the paper. So a lot of times you were always hiring, but there was no record of you hiring. Now we have Indeed, and we have all these other online job sources. So if you own a restaurant, even if you're fully staffed, you're going to constantly have an ad up there saying that you're hiring, because employees will be quitting. They always do. There's a lot of turnover in that industry. And even if you're in a different industry, why wouldn't you post on Indeed and collect resumes? And maybe you'll just find someone that you really like and bring them on. But it's almost free, if it's not free, to post, job openings. You collect resumes, or you actually hire. And you're comparing things going on now because of technology to what was going on 5, 10, 15 years ago, and it's not fair.
Yeah.
The other thing about employment is the breadth of employment. So, it's not just how many people are working, but what kind of jobs are they working in? And we're seeing some of the higher paying jobs, especially in the technology industry, being lost. At the same time, hospitality, restaurants, lower end services, which are at the low end of the pay scale in general, not always, but in general, are the ones that are picking up all these jobs. So, you're shifting jobs to an industry that is very economic dependent. When the economy slows, those jobs, all these jobs that we've picked up over the last year, which have largely been part-time, first of all, most of them are part-time, and they've been in the hospitality industries, they're going to be lost in a heartbeat.
Well, and again, and to your point, yes, and that's a very important point. And let's also think about the shift in our economy since the pandemic in particular, because that's what's driving a lot of these lower end wage paying jobs. Coming out of the pandemic, that was where really companies like DoorDash and Uber Eats and Grubhub and these type of delivery services that, basically, pay drivers minimum wage plus tips to deliver food, those really came into fruition. And, there's now a lot of jobs being created in delivery services and convenience services and these type of things. They don't pay a lot, and they have very high turnover. So to your point, I'm going to keep job postings out there for drivers and waiters and hostesses and those type of things in the leisure and hospitality sector, because those jobs are getting, again, to your point, they're quitting to go back to school, or they're quitting to go take a higher paying job in the same industry, whatever it is. There's a massive number of turnover. So I just keep those jobs posted all the time, to your point, to collect those resumes. But we've created so many of these, FedEx delivery services, Amazon delivery services. You can go to. I've told the story before about I had an Uber driver who drove for Uber, Lyft, FedEx, and Amazon, and he had 4 part-time jobs working delivery services for 4 different companies. And so if he didn't have an Uber, Lyft, he would go deliver FedEx packages. So but that's a lot of this, and this is also part of what Mike was saying. Also, is that we have a lot of people working 3 and 4 part-time jobs, and we count them as fully employed. So,
but we can critique all the numbers and the data we want. The economy is doing just fine now, right?
Sure.
The true number of layoffs is still very low. You look at like retail spending, consumer spending, it's still going well. So, as we look forward, the question, it's the lag effect. And when will the consumer start getting hit? Because the consumer is 2/3 of this economy, me and you, and the money we spend going out to dinner and movies and vacations and cars and houses. So, while we can debate the data, we don't think it's as strong as they say. It's also not very weak. It's not, we're not saying that we're in a recession now. We're not. The economy is kind of moving along. But it will get hit by higher interest rates, especially as companies take actions. When their bonds come due, and they now all of a sudden have to issue a new bond at 7, 6, 7, 8%, where it was 2 or 3%, they're going to have to reduce staff somewhere. They're going to have to cut costs somewhere, and that all trickles down. It just takes a long time for that to happen, especially when there's still so much stimulus coursing through the system. So this is going to be a drawn-out affair, unfortunately. And I think that, back to our original conversation, I think the Fed knows that, and they know, whether they say it or not, that there's a good chance of a recession at some point in the next 6 months to year or whatever it may be. And they don't want to make that recession horrendous by raising rates too far, too fast.
So too late.
Well, I agree. But I think at this point, they think they're best served going 25 at a time, but talking a big game, talking 50 and doing 25.
No, I absolutely agree with that. And I think the Fed has, again, I think we'll find out, and it's a function of time. And to your point, the economy is doing okay right now. We're still fine. But again, we are slowing down. It's just we haven't slowed down enough to be technically in a recession. But at some point, I think we're going to look back and go, yeah, we probably should have stopped hiking rates at 4% or 3.5%. Let that work through the economy, and then maybe raise some more if we need to. But we'll find out, kind of what happens. I have a feeling sooner than later. Anyway, all right, that wraps up the show for the day. Tomorrow, Danny Ratliff, Richard Rosso for Financial Fitness Friday. Make sure and get by our website for our latest articles. Of course, those are up. Michael's article on the no landing scenario and UFOs on the website now. Also, subscribe and get this weekend's newsletter. We're going through valuations and earnings and the importance of what's happening with the markets right now. That'll be in this weekend's newsletter. So make sure you're subscribed at the website. We'll email that to you Saturday morning. That's all at the website, realinvestmentadvice.com. Have a great day. See you back here tomorrow.